Good morning and welcome to another live technical analysis. Once again, starting off with the euro against the US dollar. So, note the support and resistance lines that we had placed during yesterday's live session. So, as you can see, it moved higher and higher. The narrowing of the Bollinger Bands, RSI appears to be flat at around 50. So, it looks like it's meeting some resistance at our R1 level, noted by these two wicks here. So, tried to reach up to our one, did not break above, and did not even touch. The upper Bollinger Band boundary appears to be moving alongside the R1, mid range in between S1 and R1, and then you've got the lower bound near S1. So we would maintain our sideways bias for the particular pair based on a technical point of view. In terms of fundamentals, nothing too major occurred during yesterday's trading session, except the Atlanta Fed GDP rate, preliminary GDP rate for Q1, which came in lower than expected, which may cause some concern about the US economic resiliency. Though that may have allowed the euro, the British pound to gain against a weaker US dollar and could be also attributed to the rise of the S&P 500, Dow Jones 30, and Nasdaq 100, although these could also be boosted up by the earnings season. So, for example, ARM reported better than expected earnings, which may have provided some support as well for the index overall. So, in terms of support and resistance, there's no real reason for us to change our support and resistance levels, keeping a sideways bias between S1 and R1. Once again, noting that S1 and R1 are fairly close to one another, so they could easily be broken. But based on the recent price action in the past day, appears to be validating our support and resistance levels. As such, we're going to be moving on to the dollar against the Japanese yen. Now, the easing of the hawkish rhetoric from the BOJ may have weakened the Japanese yen, so propelling the Nike higher, in addition to stocks based in Japan. In terms of forex, however, the dollar against the Japanese yen, dollar appears to be gaining against the weaker Japanese yen. I would not attribute this to dollar strength, but rather the yen weakening. So for this particular pair, we would maintain a bullish outlook. RSI near 70, so it's at 64.7, implying some bullish market tendencies. But for our bullish outlook to continue, it would have to break R1. Now, if it does not break above R1, I would switch towards a sideways bias between R1 and S1, staying between these two boundaries. And if it does manage to break S1, I would switch for a bearish outlook. In terms of financial releases, nothing too major as well for this particular pair. Moving on to cable. British pound, still above S1. So I think I'm going to be readjusting my resistance level. So taking this previous low, so the opening and closing of these two candles, respectively, validated at a prior point in time. And since the price action has been relatively muted, and when I say muted, there's nothing too significant like these two bearish candles. There are some smaller increments towards the upside. So sideways bias between S1 and R1, which I'll be changing right now. 1 point, actually, so for R1, we could have 1.2655. So that would be my R1. Nope. Narrowing of the Bollinger Bands as well. RSI 50, so neutral market sentiment. I'm maintaining a sideways bias between S1 and R1. And then this is R3. BOE's man is expected to speak later on today, so that could actually impact the cable. If they do sound hawkish, provide support for the British dollar, but from a technical point of view, sideways motion between S1 and R1, although relatively narrow, appears to be staying in between these two particular levels, at least for now. Dollar against the Canadian dollar, broken the upwards moving trend line, staying in between S1 and R1. 50 RSI, 47, but close to 50. Sideways bias between S1 and R1. The increase in oil prices could potentially support the loonie, excuse me, the Canadian dollar. Yes, the loonie. Aussie against the US dollar. Now, in terms of the Aussie, we had China's CPI and PPI rates out earlier on today. So the PPI rate came in better than expected, but is still in disinflationary territory. The CPI eased, so lower than expected. Now, that is a bit of a concern for China. And why are we saying that it's a concern for China? Well, there is some sort of hesitancy in terms of the Chinese economy's economic outlook. There might be implying that there is a reduction in demand in the Chinese economy. So if you're demanding less in an economy, that means there's less need to import raw materials. And the closest exporter is Australia. So if the Chinese economy is not looking that well, so if there's issues about demand or concerns, it could potentially weigh on the Aussie. So for the past day, moved lower, potentially fears stemming from China about their economic resiliency. Now, those fears could prompt the Chinese government to amp up their pressures to alleviate those concerns. So, in such a scenario, where it may be perhaps announced that the Chinese government might be introducing new measures to boost the economy, we could see the Aussie gaining. But for now, those concerns appear to be predominant, to be dominating the pair. So once again, not dollar strength, but Aussie weakness, staying between S1 and R1 from a technical point of view as well. Narrowing of the Bollinger Bands, implying low market volatility, RSI 43. So slight bearish tendencies, but overall would maintain a sideways bias again for this pair. In terms of oil, moving higher. Now there was a slight paradox. So the EIA weekly crude oil inventories figure indicated an increase in inventories, so potentially implying a reduction in demand. Yet why is oil moving higher? Well, it appears that the comments made by the Israeli Prime Minister about the potential continuation and extension of the war may be causing concerns about the outlook in the Middle East. So, in terms of the supply chain, so if the war continues, there might be concerns about supply, therefore, potentially providing support for oil, despite the US weekly crude oil inventories implying an increase, so implying a reduction in demand. As such, we may see oil prices moving higher, aiming for R1. RSI is still at 54. So what we said yesterday, staying between S1 and R1, is valid. Yet, once again, I'm noting that the distance between S1 and R1 is fairly significant, about $4, and as such, it would be easy to say it stays between S1 and R1. But if it does manage to break above R1, I would maintain a bullish outlook for the commodity. If it breaks below S1, switching for a bearish outlook. But for now, appears to be moving between S1 and R1 in a sideways fashion from a technical point of view as well. But we could also say that this might be forming an upwards moving trend line. So we would keep a close eye on the commodity. In terms of gold, so dollar weakness remained relatively unchanged, however. Still between S1 and R1. If we narrow this up, stays in between. Readjusting my support levels this week, taking these two candles here. So 2042, that would be my new R1, 42.35. Actually, 42 point simply 5 should be enough. Then for support, 2014. So simply readjusting 2014, adjusting my support and resistance level. So it's simply a dollar, not much of a difference on the support side. Then 2042.5 for my R1, R2 2075, and you've got R3 2135, and then S3 1930, 1972, 2014. So it's still validating an upwards moving trend line. So you might you could imply that there are some bullish tendencies in the market. Overall, those staying between S1 and R1 are sized at 50. There is an upward moving trend line, but note how the Bollinger Bands and moving averages have smoothened out, applying low market volatility. So staying between S1 and R1. So in terms of the S&P 500, it's broken above our support, our resistance level, opened very nicely with this bullish candle on 4,950. So validating this as resistance now turned to support. So this would be S1. And then you have our next target being 5,100, or one could say 5,000 in terms of a psychological level, which is currently here. But I'm going to be keeping 5,100. But one could say an intermediary resistance level could be the 5,000 level. So we've got 5,100 as our one, then you've got our two at 5,250. Overall, we would maintain a bullish outlook for the index, RSI running along the figure of 70, two upwards moving trend lines, Bollinger Bands being tilted towards the upside, in addition to the 50 and 100 moving average also appearing to be tilted towards the upside. So maintaining a bullish outlook for the index. And yep, all-time highs. So we need to figure out where R3 could potentially be. I would reflect the distance between R1 and R2. 15,099. 5,400 R3. Simply measuring the distance between R1 and R2. And also coincides with the big figure. So psychological impact, 5,400 is a big number. Could potentially meet resistance at that level. For now, our target is 5,100. If it breaks below S1, next target could potentially be S2 at 4,800. I'm not seeing any signs of a reversal just yet. So it could actually come down, test support, move higher, aim for R1. Then you've got R2. Bullish outlook to continue would have to break above R1, or at least slightly break above R1. And then let's readjust our text labels. And this becomes R3, 5,400. Overall, the economic outlook in the US looks all right. But personally, I'm a bit of a skeptic. I'm concerned about the potential fallout from credit card loans in the economy and the ability of consumers to continue spending, especially if interest rates are kept at their current levels for a prolonged period of time. Then I think that the risk of a recession might come back, but that remains to be seen once again. So we've got S1, S2, and S3. Upwards moving trend line continuing to be validated since roughly the 18th of January, moving in an upwards fashion, broke above resistance to the support, and as such, we would maintain a bullish outlook for this particular index. Now, Nasdaq 100 moving higher. Target is S1, 18,000. I could bring my support level slightly higher, presenting this bearish and bullish candle. 17,165 would be my newest one. Keeping S2 at the lower level, just in case it does decide to break below S1. We have S2 that is slightly further away than S1, since we're bringing our support level closer to the price action. This would be 17,165 for S1, S2, 16,165. Then you've got S3, 15,350. For R1, 18,000. R2, 18,800. Then you've got R3, 19,600. So I've got R1, R2, R3. Upwards moving trend line, Bollinger Bands tilted towards the upside, RSI near 70, moving averages also being tilted towards the upside, also imply a bullish outlook for the Nasdaq. Dow Jones 30, so the industrial average. Let's just remove this trend line. Upwards moving trend line since roughly the 20 something of October, 27th, moving higher, validated on 3 occasions, so making this a valid trend line, aiming for our 139,000. Then you've got our 240,000, our 34100, 41,000. Then you've got S1, 38,000, S2, 37,100. RSI still near at 70, so further implying a bullish market sentiment. Now, if it breaks below our upwards moving trend line and moves down to S1, I would switch for a sideways bias between S1 and R1. If it breaks it slightly but doesn't close. So when I say if it breaks it but doesn't close, I mean if it wicks down, but the actual candle does not close below the upwards moving trend line, I would still maintain a bullish outlook. For a bearish outlook, it would simply have to make a clear break below S1, so closing below S1 of the S1 level of 38,000. Then for a bullish outlook, simply breaking above R1, so 39,000. So wicking up, testing resistance, taking some liquidity, moving higher. Then R2, 40,000 would be sufficient for a bullish outlook to continue. British Airways on a daily move slightly higher, so I expect this to be market correction. Let's just make these a bit bigger. I like looking at British Airways. It's in the news, it's interesting, and it appears that everything that comes out regarding I said British Airways. Apologies, it's Boeing. Boeing. Everything that comes out for Boeing appears to be negative. So market correction, staying between S1 and R1, 200.45 and 216.25. So sideways motion between S1 and R1. Overall, still maintaining my bearish outlook for the company stock price on a fundamental level, but from a technical, appears to be moving between S1 and R1. Then for S3, so keeping the same support and resistance level since we had yesterday, R1, R2, then R3. Nothing needs to change. We're going to be looking at ARM as well today. So ARM is an interesting story. Better than expected earnings, so it's moving higher. If I'm not mistaken, some news outlets reported that in pre-market trading it moved up to 100 before settling at $77. But let's just check. 77, yep, roughly there. Template, these are templates that we already have. If you right click, go to template, you have some preset ones. Let's add an indicator, Bollinger Bands. I'm not going to use ATR today. Maybe slightly overbought, maybe do market correction slightly lower. Let's look at the 4-hour time frame chart daily. So let's go back to the 4-hour. Let's just move these to the side. Just a second. Let's also insert volume. Let's just see where this top was. Right. Resistance. At 78.55. So that would be my R1. High activity. Came back on 2 occasions. Managed to pierce through, but did not close and moved lower. So this would be my R1. For my support level of S1, taking this recent price action, I will not bring it up here. would be a bit too close. So 70.30 for S1. Then for S2 at 63.70. Let's see if it's 63.70. So giving it some room. Also coinciding with this price action here. Failed to break above, but when it did, came back down. So resistance turned to support, further validating this as potentially a genuine support level, 63.70. Then for S3, taking this old high, validated on two occasions. When it managed to break up, moved higher, 56.05 for S3. Yes, there is a bit of a difference between the support levels, but since we don't really look at this particular chart on a daily basis in our lives, this could be used from a more macro perspective. As you can see, this was in December, so potentially being valid for perhaps a month. But once again, that depends on the price action. And now we have the dilemma of finding R2 and R3, given that we don't have historical data and it's never actually reached this high. So let's see, where would we place R1? The distance between S1 and S2, 61 ticks. So 84.5 or 84.6. R2, so simply measuring the distance between S1 and S2. And then I'll take S2 and S3. 757. 9205. So we've got R1, R2, R3. Technical point of view, nice upwards moving trend line since the 6th of December 2023. Wicked, so one and then multiple touches, so validating an upwards moving trend line. Personally, I would be bullish for the company's stock price. Earnings went better than expected. High demand for semiconductors, alternatives to Nvidia. So the hype continues, could potentially gain in the future. But for my bullish outlook to be maintained, I'd like to see it break above R1 at 78.55. Next target being 84.60. If it breaks below my upwards moving trend line, would coincide slightly with S1. So if it breaks below and opens below S1, would switch towards a bearish outlook. Sideways bias would have to fail. If it fails to break above R1, I'd switch towards a sideways bias. I would not switch towards a bearish outlook. For bearish outlook, it will have to break below S1. So my two possibilities currently are either bullish or sideways, and then lastly, bearish. 63.70. For S2, then 56.05. For S3, so if it does manage to break above R1, bullish outlook up until R2. Tesla, still in between our S1 and R1 level. Make this bigger. Crossover, so change in direction. Market correction could potentially move lower. This could have been a breakaway gap. Tested. We're maintain a bearish outlook for the company stock price if it manages to break below S1. If it does not, sideways between S1 and R1. Technical standpoint, breakaway gap. If it does break below, it creates a gap. That would be a measuring gap or continuation gap. Very nice by IBM. Have a look at IBM in a bit. ExxonMobil finding support at our S1 level, so 101.50. So staying between S1 and R1. Just place this text labels. 1.50. Then 96.4 for S2. S3 89.0. R1 104.78. Bounced off our S1 level, so I'm pleased with the placement of S1. No need to change that. On a 9.10 for my R2. And then lastly for R3, 113.55. Tight sideways bound between S1 and R1. 50 RSI, smoothing it out. I'm guessing the Bollinger Bands have smoothened out as well. Converging around S1 and R1. Bullish outlook would have to break above R1. Bearish, simply below S1 for now, between S1 and R1. BP. Break down lower. Readjusting our support level. 468.10. S2 452.60. I'm guessing this might be a market correction. Came back down, found support, moved higher. Maybe we could see the next 2 4-hour candles staying near S1 before it moves higher and then takes aim at R1 once again. If the bulls remain in control. If the bears are taking over, would like to see a break below S1. Clear break, not simply wicking through. Next target being S2 452.60. Then I've got R3 at 520.48. Nothing major happening around ExxonMobil. BP. New Zealand dollar stagnated, so still in between S1 and R1. Might come back down lower before continuing higher, but staying between S1 and R1. Nvidia taking aim for the resistance level of 713.40. Other than that, you've got 833.70. Bearish outlook will have to break below upwards moving trend line and S1 of 613. Let me just add some text labels as well, make this easier for you to see. Technical standpoint, 81. It might be overbought. Yes, so it might be due a market correction down to S1, which would coincide with the mid range over the Bollinger Bands. So if it does come back down, would not be surprised. The managers to break below S1 would switch for a bearish outlook. 504.30. 391.70 for S3. Continues to validate our opportunity trend line, so still maintain a bullish outlook on the company stock price. R1. If there's something you'd like to see, feel free to ask. R2, 833.70. R2. Then R3, 955. So we've got R1, R2, and then you've got R3. There we go. Upwards moving trend line continues to be validated. Apple. Nice. Validating our upwards moving trend line continues to move higher. Not really seeing an island reversal formation. Strong support at 109 at 179.15. Staying between roughly $20 of space, so 195.30, 179.15. Smoothing it out of the moving averages. Let's see. Netflix still above S1, then break above R1, staying between S1 and R1. And we have time for one last one. Going to be looking at Disney. Disney announced roughly 1.3 or 1.4 $1 billion investment into Epic Games. That's surprising considering they were suing each other, because that may have buried the hatchet. Now, how could this impact Disney's stock price? Well, one theory could be if they're shelling out 1.3 billion, then that could actually weaken the stock price. But in the long run, if that agreement reaps some benefits, so they make money of it, provide support for the company's stock price. So it basically depends whether you believe that it will be beneficial in the long run or it will not. But let's look at it from a technical point of view. Upwards moving trend line. See it from this wick. 3 touches, so valid upwards moving trend line. 70 RSI. Appears to be pretty bullish. Well, not pretty bullish. It appears to be bullish, simply put. My R1. Note where it dropped. It's close to the price action, 100.15. So this is R1. Then R2, I take it from the when this began. Came 3 occasions it tried to break up, did not. 102.90. And then for R3, 105.15. Bullish candle, met resistance, moved lower. Now, in terms of support, take the recent price action. So I'm looking around here. I usually like to take the candles, and this is why. Look, this was a swing high, closed, tested, found, wick through. So it's roughly between this and this here, where there are the two wicks. So in between here, so about $1, I would expect to find support. So 96 for me is a good support level. I like taking the opening and closing of candles instead of the wicks. Find that it might have more support or resistance respectively. Sometimes there's another option, so we might have to take the wicks. But this would be my S1, 96.0. And with the same methodology, moving lower, as you can see, on numerous occasions. So this could have been potentially, let's say, for example, this was validated prior. That placed it, wick through, could have been a potential long, then came back down, moved higher, 93.42 or 40, 42. And then for S3, around, I'd say, 90.3. So I've got S1, S2, S3, R1, R2, and R3. Technical, RSI 70, upwards moving trend line. So I would maintain a bullish outlook for the company's stock price. And with that, that does it for today. Thank you for watching.
I guess we'll just go ahead and get started now. So, first things first, as per usual, a disclaimer. So, products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today's webinar on support and resistance. So here's our agenda for today. Firstly, we'll be looking at using swings for support and resistance levels, followed by looking at where exactly you should place your starting points. And then we'll be going into pullbacks and overlaps and combining these two in order to use these with Fibonacci as well. Okay, let's get started. So firstly, we'll go into how exactly you can use swings for support and resistance levels. So support and resistance levels in trading basically refer to prices at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, chart patterns, so on and so forth. Additionally, you can also look at previous highs and lows of the asset, as well as volume data to identify potential levels of support and resistance. So this is basically what we will be focusing on today. And it's important to note that these levels are not absolute and can change over time. So continuous monitoring is necessary. So I've added an image here for you to see how exactly we can use swing highs and lows as resistance and support levels, but we will go through it more in depth in the next few slides. So take note of how there are clear peaks and troughs in the market structure, and these areas can be used as your support and resistance levels. Okay, so firstly, let's look at an example of insignificant swings. So these are bad points to use for Fibonacci starting and ending points, but they're also not exactly good to be used for resistance and support levels. And I've shown you an example here in the GIF. So you can see that the um, price movements are really small and there's no significant swing highs or lows. Here's another example. So once again, there aren't really very clear swing highs or lows, and price movement is very small. Okay, and now let's take a look at a correct example of significant swings. So here you can see that there is a clear move up and down with obvious peaks and troughs and yeah, clear market movements basically. So in this GIF, that's basically what you are looking for when you are deciding on a chart to analyze on. So people may ask like which time frame do you use, which time frame do you recommend? And it's completely up to you. It depends on what kind of trader you are. So if you're a scalper, of course, a smaller time frame would be better. And if you are a swing trader, a longer time frame would be better. Okay, but still, when deciding which time frames to use, a important consideration is also the clear market structures. So you want to look for something like this, a clear market structure with significant swing highs and swing lows. Okay. Okay. So support and resistance. You can use these levels as take profit and stop loss levels. But you should not use it as an entry if there are no other supporting arguments, such as Fibonacci or other graphical levels to support your analysis. Using a recent swing high or a recent swing low is typically considered a weak level if it's just that level alone. So you can see in this GIF here, oops, in this GIF here, the recent swing high and lows, although they are significant, so you can see them very clearly, but they are not strong levels to use because we don't have additional Fibonacci levels to support them, and we don't have pullback or overlap support levels or multiple swing high or swing low support levels. So I'll show you what exactly I mean by that. So this is typically what you want to look for. So we're looking for multiple swings. So if at least two swing high or swing low levels line up nicely, these are typically much better levels to use. So you should try to find areas where these might line up, and it does not necessarily have to be at the exact same level because these tend to be areas more so than levels. So in this GIF here, you want to see how far you can, yeah, You want to see how far back your resistance or support line can go, and it's okay to cut through small wicks, since support and resistance levels are usually in areas. Okay, so you can see here we have four swing highs that are about the same level, and we want to avoid cutting too many candlesticks. But if you're just cutting the wicks like in this example here, that's perfectly fine. Okay, so now that we know how to identify significant swings and use them as support and resistance levels, what are some things that we can look out for when inputting a support or resistance level? Okay, firstly, picking a starting point. So when picking the starting point of pivot, which is your entry level, support and resistance levels, these are typically your rules that you can follow. Hmm, excuse me. So firstly, we want to check if there is a swing high or low, and we've gone through those in the previous slides. We also want to look for pullback or overlap levels. So if you are wondering what exactly those are, I'll get into those in the coming slides. Next, we want to go as far back as possible. So as you saw in the previous slide, I did mention we want to try and pull it back as far as possible without intersecting too many bodies of the candlesticks. So we want to avoid cutting the thick part of the candlestick and just the wick. So just the little sticks on top of the candles, those are perfectly fine. Okay, so the orange thumbs over here represent an okay intersection. They're not preferred, but not exactly wrong. But preferably, we want to look for intersections that are only of the wicks, like over here. Okay, some more examples over here. You can see this thumb, this red thumb is what we want to avoid because it's cutting too many bodies of the candlesticks. So these green thumbs are what you typically want to look out for, where you are just cutting the wicks of the candlesticks. Okay, okay. Another example here. Um, Similarly, this red highlighted area, it's not preferred because you're cutting too many bodies of candlesticks. Okay, yeah, so the green thumbs, again, just cutting the wicks of the candlesticks. So something like this, would have multiple swing highs. We can just stop the support, or in this case, resistance. We can stop the resistance level just at this green thumb here. And it would already be considered a pretty significant level because we have three swing highs that line up nicely at the same level. Okay, which is important because you can see that price has tested this level many times before. Okay, next let's go into the pullback and overlap. Let me know in the chat if you guys have are aware of what exactly pullback and overlap level is before I show you guys the next slide. Okay, I think Yeah, because I do mention these a couple of times in our previous webinars, but no worries. Let's just go ahead and take a look at these. So firstly, we have pullback. So pullback, from the name suggests, we are expecting price to pull back to a certain level. Okay, so it's basically a strong level of support because it breaks out from a previous resistance level and price is now dropping back to visit it again. So in this case, we're just talking about the pullback support first. So if you take a look at the GIF, this is a pullback resistance. So just ignore that for now. Okay, pullback support is basically the opposite of that, where we are expecting price to retrace back to your support level. Okay, so a pro tip is when a pullback support lines up with a Fibonacci level, it's typically considered to be very powerful. For pullback resistance, these work well when it breaks a significant swing low and then starts pulling back to it. So it's even better, again, if there are multiple Fibonacci levels that are lining up with it. So here in this GIF, we have, okay, ignore the Fibonacci levels first because it is a little bit messy. But if, maybe I'll just refresh it. Okay, so here is our swing low for reference. Okay, so this is our swing low that we are using as a support level for now. But since price has already broken it and it's dropped below the support level, it's then a resistance instead. Okay? It's a resistance because we are expecting price to reverse off of that level. And that's why we call it a pullback resistance because we are expecting price to retrace back to the level and pull back to it. Okay, it is a little bit confusing, so let me know if you guys have any questions. But now if we talk about the Fibonacci levels. So here we are using a Fibonacci retracement. Okay, and I'm circling the 38.2 because it lines up nicely with my retracement. Once again, I have another retracement. In this case, the 61.8 lines up with my resistance, pullback resistance level. Okay, and now you can see that price really pulled back to our resistance and bounced off of it and headed downwards again. Okay. Okay, maybe I'll just let you guys watch the GIF one more time. So price has broken out of the support level, the swing low support, becoming a pullback resistance. Okay, and now that the resistance lines up with not one but two Fibonacci retracements, it's considered a confluence area. That's why I've highlighted it. Okay, and yeah, you can see price reversing off of the level again. Okay, so confluence areas typically are considered quite important levels because you have multiple Fibonacci levels or moving average levels or whatever that line up with your support and resistance. Okay, so those are is basically evidence that price is likely to respect that level again. Okay, so here's an example. Firstly, I have three swing highs that line up nicely. Okay, at this area, this red highlighted area. Price breaks out of the resistance area and it moves upwards. Okay, moves upwards, and once it breaks out of this area, it's considered a not Fibonacci, it's considered a pullback support. Okay, um, basically, when you have a resistance, once price cuts or breaks out of the resistance, it's then the opposite. So then it's a support instead. Okay, so then we call it a pullback support because we're expecting it to pull back or retrace back to the level, as you can see from the dotted arrows here. Okay, another example. In this case, we have a pullback resistance. In the beginning, we have three swing lows that line up nicely. Okay, so swing low, we would think of a support. Now that price has broken out of the support level, it's then a pullback resistance instead. Okay, so the pullback resistance, we're expecting it to retrace back to that level. Okay, another example here. So we have a significant swing low here over the circled area, and thus it is a possible support level. But now that price has pulled back and it has surpassed the swing low support, it is then a pullback resistance. Okay, so now let's see if price pulls back to this resistance level. And you can see that it actually did. Okay, so price has reached the pullback resistance level just as we expected. And once it reaches and reverses off of it, it will then be called a resistance overlap resistance level, which is what I'm going to get into in a little bit. Okay, okay. Next we have the overlap support and resistance. So an overlap support occurs when there are prices that touch the line from the top and from the bottom. So the more times that it reacts off of that area, the stronger the level is. So the reason for this is because it means that there are bulls and bears that are respecting that area, and therefore it's an important point to take note of. Okay, so once again, if your overlap area lines up with other elements such as Fibonacci or graphical elements such as your um, moving average or pivot points, for example, it will make it even stronger. So in this GIF, an overlap resistance happens when price touches it from the first point, which is over here, and from the bottom, which is here. Basically, when there is a swing low and a swing high that line up nicely in the same area. That's basically what an overlap level is. Whether or not it is a resistance or a support depends on what the latest where the latest point touches the line. So if it touches it from the top, it is a support. If it touches it from the bottom, then it's a resistance. Okay, here's an example. So the swing low support becomes a pullback resistance once price breaks the support at this 105.643 level. Okay, so you can see in this GIF how price retraced or pulled back to this resistance level and in fact reversed off of it, making it now an overlap resistance. Okay, so you can see here the minute that price, okay, here in the original image, price broke out of the swing low support. So once it breaks out of the swing low support level, it is then considered a pullback resistance. And once price retraces that level and reverses off of it, then it is a overlap resistance. Okay. Okay, let's move on. So now we're going to combine both pullback and overlap levels. Okay. Excuse me. Okay, so here we have a big swing high resistance level. Okay, at the start. And price surpasses this level over here. Okay, so the moment price surpasses this swing high resistance, it now becomes a pullback support instead. Now, price has made a pullback to our pullback support and has bounced off of it perfectly. So once price bounces off of it, it then becomes a overlap support instead. Okay, another example. So we have two swing highs that are lining up. You can see these purple circles here, and we have a swing high resistance from this. So price surpasses this level here, it breaks out of it, and then becomes a pullback support. Number three, point three, price has pulled back to our support and has bounced off of it twice. So the blue circles is where price bounced off of it. So once price bounces off, it now becomes an overlap support. Okay, I think by this time you guys probably have gotten the hang of it. So this is just my last slide, and then we will take a look at some charts. Okay. So once again, combination of pullback and overlap. Firstly, we have a multiple swing low here. Okay, 1, 2 circles here. Point two, pullback resistance. Once price breaks the multiple swing low support, it then becomes a pullback resistance, and then it reverses, pulls back to our resistance, and reverses off of it 3 times here. Okay, so once price breaks out of this overlap resistance, it then becomes a pullback support once again. So every time it crosses the level, it basically switches from a support to a resistance or from a resistance to a support. Okay, and then point five, lastly, price has pulled back to our support and reversed off of it. So this level at the 33420, you can tell that it's a very significant level because price is continually retesting it. Okay, so what's important here is that because it's a pretty significant level, you can also expect Fibonacci levels to line up nicely with this level. Okay. Okay, now let me pull out my trading view and then we can take a look at some charts together. Let me know in the chat if there are any specific charts that you would like to see. Okay. Um, okay, here are my charts. Okay, if there are no specific charts that you guys would like to see, I'll just go ahead and maybe analyze gold first. Okay. Oops. Okay. Okay. So this is an example of a really clear um, price movement. Okay, so we have 3 swing highs here, and you can see really clearly, the peaks here. Okay. Okay. So we have a swing high, multiple swing high resistance here at this level. Okay, and we can see price um reversing off of it. Okay, and this is on our weekly time frame. So we like to look at higher time frames first so that we get an idea of what the general direction of price is on a zoomed out kind of basis, and then we can compare with the lower time frames after. So once again, I'm looking at this on a weekly daily time frame. Okay, and I can see that we have this decreasing trend line. So I think in our next webinar next week, we will be talking a little bit more about trend lines and trend channels, but I'll just briefly go through what makes um a valid trend line. Okay, so what makes a valid trend line is if there are at least 3 touches on a trend line. And if it is decreasing, your trend line should be drawn, or rather, if it's a downtrend, your trend line should be drawn like this from the top. Okay, if it is a ascending trend line, then we can draw it like this, so from the bottom. Okay, but of course, this trend line is not valid because I don't have 3 touches on it. But this is basically what you are looking for a ascending trend line. Yeah, so sorry about my throat. The weather is getting cooler, so I'm feeling a bit under the weather. Okay, so now let's look at the 4-hour time frame. So we typically like to analyze either on the 4 or 1 hour time frames, and how we decide between the two is like I mentioned earlier, by looking at the chart structure, okay, the price structure. So you can see on our 1 hour time frame, it isn't really nice to analyze on. And the reason for that is because price movement is like pretty small. Okay. It's quite small. But if we look at our 4 hour time frame, you can see that we have much clearer price movements. So that's basically what we look for. Okay, so I'm gonna analyze this on our 4 hour time frame. Okay, let's see. We're gonna start off by identifying the trend. So we can all agree that this is a descending trend line, right? Or rather a downtrend. Now I'm gonna see if I can find any graphical analysis to support that. So I kind of have a descending trend line here. Okay. Now that I've done that, the next step is to go in with support and resistance levels. Okay, here is my my second support, second resistance, my first. Okay, I'm gonna see if I can find a closer resistance level. Okay, this level here is my first support. Okay, and then my first resistance, maybe here. And then my second support just here. Okay, so maybe just a recap. So my second resistance, I have a swing high here and a swing low here. So it makes it an overlap level. And then I also have another um swing low here. Okay, so I have bulls here and bears, both of these areas respecting my second resistance. So it's a pretty significant level, and that's why I have labeled that. Okay, and my first resistance, I just have a swing high here. Price has kind of broken out of these levels. Okay, so I only have a swing high level here. Okay, and that's the reason why my next step is to go in with Fibonacci levels to try and support these levels a bit more, or adjust them and see if I have any better levels to use. Okay, first support is because it's the closest swing low to where price is currently at. Okay, and it also respects a couple of swing highs and lows. Okay. Second support, the reason why I put it there is because we have this swing high here and a couple of swing lows here as well. Okay. Yeah, and it's also basically the closest level to my first support. Okay, now let's go in with our Fibonacci levels. Okay, so here I'm using a Fibonacci projection. Okay, and for Fibonacci projection, we use these three levels, and we use the tool Fib extension. Okay, that's on TradingView. If you're looking at MT4, I think it's also this symbol, but I don't think it's called an extension, but it basically has 3 points for you to analyze. Okay. And for Fibonacci X projection, just to recap, if you weren't here for our Fibonacci series, we look for a flash, okay, a flash or like lightning bolt kind of shape. Okay, something like this. Okay, here, even though you can see my 78.6 lines up nicely with my first resistance, this is no longer valid because price has already broken out of the level. Okay, so I'm just going to keep my 100% here. That lines up with my first support. Okay. Um, mm, okay. Here I can see that this Fibonacci retracement lines up with my 61.8. The 50% is no longer valid because price has already broken out of it. Yeah, so just my 61.8. Okay, and this is a retracement. So for retracement, we use the 5 levels that I was using earlier: 23.6, 30.2, 50%, 17.6, and 61.8. Okay, I think that's all the levels that we have here. Okay, I think that's all the levels we have for Fibonacci. So the next step is to go in um with some indicators, and my favorite indicators to use are the Ichimoku and the MACD. For Ichimoku, I like to just look at the cloud, which is just the plots here. Okay, because if you look at all of the lines, which you can as well, but it is a little bit messy. Okay, so I like to just look at the clouds because at one glance, you can see exactly what the signals are. So if price is moving below the Ichimoku cloud like it is here, price is moving below the Ichimoku cloud, so it is a bearish signal. Okay, so it supports our analysis that price is likely going to continue to drop from the first support down to the second support. Okay, um, but over here, our MACD is giving us a bit of a bullish signal. You can see from the green here. Okay, and the reason for that actually could be because, as I mentioned earlier, our first support is here. Okay, and it's a pretty significant level with the swing highs, the swing lows. So it's an overlap support, and we can expect price to come back and retest this level, which is doing now, as you can see. And on top of that, we also have this 100% Fibonacci projection. Okay, that has not been it's not been surpassed yet. So we're still seeing price test this level, but because of the downtrend from this descending trend line, we saw on the daily, the weekly time frames that price is still pretty bearish on those levels, on those time frames as well. So we can expect price to continue to drop towards the second support because of all the downward pressure. Okay, but for now it is still testing our first support. Maybe we can use another indicator. Okay, let me know in the chat what indicators you guys like to use. Okay, I like to use these three. Okay, on our RSI, we're also seeing a decreasing trend line. So it's also supporting our bearish signal here. Okay. Let me know if there are any questions. Oops. Okay. If there are no questions, I think we still have time for one more chart. So if you guys don't have any requests, I'll just go ahead and do maybe the Aussie dollar because we recently saw the RBA releasing a cash rate statement. So let's take a look and see how price affected the charts there. Okay, so same thing, I'm gonna analyze this on a weekly chart. Okay, let's see. Yep, we have a descending trend line on our weekly time frame. Okay, next, if we take a look at our daily time frame, also descending trend line here. Okay, remember the three touches here. Okay, next on our 4-hour time frame. So once again, I'm deciding between 4 or 1 hour, but both of these charts seem to be pretty clear. Maybe I'll just go ahead and analyze this on a 4-hour time frame. Okay. In this case, I don't really have a descending trend line, I think. Yeah. Let's see. Okay, I don't really have a descending trend line here. Okay, but we can definitely see that the trend is downwards. Okay. Now, I'm gonna go in with my support and resistance levels. Okay, this is my first resistance and my first support, maybe just here. And my second support here. Okay, now we'll go in with some Fibonacci levels again. Okay, we don't really have very nice levels here. Okay, my 100% level lines up with my second support. Let me see if my 78. Okay, it lines up, but it's no longer valid because price has already broken out of it. Okay, so just my 100%. Next. Okay, I think my 38 lines up, yep, with my first resistance. Um, okay, my 61.8 also lines up with my second support. Okay, so you can see here I have a confluence lab area here. Okay, so what I am doing here is I have recognized this Nike tick shape. So it's upside down, but this is the shape that I'm looking at. Okay. Um, yeah. So for this, we are using the Fibonacci extension tool. So it's the same retracement tool, but instead I'm looking at the 127.2 and 161.8. And I can see that both of these levels line up with my second support. Okay, and I feel like that's one of the reasons why you can see this reversal of the first support here. Okay. Okay, now let's pull out some indicators to support our analysis. Okay, price is moving below the Ichimoku cloud. So it's giving us bearish signals. MACD is also giving us a bearish signal, so we can expect price to continue to drop because of all the downward pressure. Once again, our indicators are also supporting this. Although we are seeing this rebound off of the first support, as I explained earlier, it's likely because of this 127 and also because of the release of the RBA cash rate. Okay, but yeah, there's a lot of downward pressure, so we can likely expect it to continue to drop towards our second support. Okay, confluence areas also tend to have confluence areas also tend to attract price. So we can expect price to reverse off of it, but we are also expecting price to be attracted to this area. Okay, so areas like our second support, where you have the 100% Fibonacci projection, 61.8% Fibonacci projection, and this huge swing low here. So we can expect price to continue to drop here. Okay, any questions before we go? You have to include the wick in swing high and swing low in putting resistance and support. Um, for Fibonacci, I feel like it's good practice to include it. But for support, swing high and swing low and putting for resistance and support levels, it doesn't really matter because as I mentioned earlier, it's more so levels, areas rather than levels. So you can see here, even though I didn't include the wick here, right? Okay, let me zoom out. But you can see I actually highlighted this area here because of my Fibonacci levels that line up nicely. So for these support and resistance areas, I am expecting them to be areas more than levels. So yeah, it doesn't really matter for support and resistance levels. Okay, I hope that answers your question. Okay, any other questions? Okay, if there are no other questions, yep, no worries. Thank you guys so much for joining me today. I hope you guys found this helpful. And for part 2, I'll see you guys next week. Thanks, everyone. Have a great rest of your week. Bye.
My name is Emily and welcome to another one of our videos. Today we'll have a look at currency carry trade. A currency carry trade is one of the most famous trading strategies in forex trading. A currency carry trade is when you buy a currency with a high interest currency against a low interest currency. Carry trading involves holding a forex trade when one currency has a higher interest rate than the other currency in the pair. The most famous carry trades involve buying currency pairs like the Australian dollar against the Japanese yen and the New Zealand dollar against the Japanese yen, because these pairs have interest rate spreads that are very high. A trader can make a profit between the difference in the interest rates of two currencies as long as the exchange rate between the currencies does not change. Many professional traders use these currency carry trades because the gains can be very big when they use leverage. However, the bigger the potential gain, the higher the risk. The currency that is exchanged in a currency carry trade transaction is known as the funding currency. A funding currency usually has a low interest rate. Traders borrow the funding currency and take short positions in the asset currency, which has a higher interest rate. The best time to get into a carry trade is when central banks are raising or considering raising interest rates. Also, these trades work well during times of low volatility since traders are willing to take on more risk. As long as the value of the currency doesn't fall, even if it doesn't move much or at all, traders will still be able to get a return. However, a period of interest rate reduction does not provide great gains in carry trades. When rates are falling, demand for currency also tends to fall and selling of the currency becomes difficult. Basically, the carry trade can result in a profit if there is no movement or an increase in interest rates. Hope you found this video useful and interesting. Thank you so much for watching us. Bye-bye.